Hello, welcome back, everyone. This is Seewing Yee, and my co-host is Mr. Richard Advani from Guaranteed Rate Mortgage. Richard has done thousands of loans for real estate investors all over the U.S. So he has a real knowledge around the pulse of what's going on in the housing market. So welcome, Richard. I know you're very busy doing loans for investors every single moment of each and every day. Thank you for your time. So without further ado, let's go over briefly for a few minutes the first topic, which I believe is a game changer. This loan program for investors are available in these select markets. Not every builder are participating in this, or especially some of the mainstream big builders in this country. They they may not want to participate in this loan program because they have their own in-house mortgage lending. However, there are a number of local builders in select markets. They are already or about to participate in this great investment program, which I feel is a game changer for real estate investors, especially those who are waiting on the sidelines. So this program is a 4.99% mortgage interest rate. I believe it's 30-year fixed rate mortgage. And this is a game changer because it'll allow investors to increase their monthly cash flow significantly with 25% down payment. Furthermore, some builders, this kind of incentive is really a game changer. Some builders add-ons, they're also providing an investor with 12% credit on closing costs as well. And a third great incentive that this investment program provides, and some builders, they're giving like 2 years of free property management. So all of these three main drivers will significantly increase our potential risk investors' cash flow moving forward. So with that in mind, so Richard, you are in a forefront of this amazing 4.99% loan program. So what is the status? What's going on with this program at this time?
Yeah, absolutely. And it is, as you mentioned, really a game changer of a program, not only obviously for us in the industry, the bigger thing is for clients themselves. You often hear about new products in the mortgage industry, and most of them feel like a dangling carrot, right? They sound good. And then when you call and you find out the details, most of the time it doesn't really fit the needs of what any of us want as investors or the risk profile. However, it's a good marketing tool. Now, what's different about this program is it's not only that dangling carrot, but when the customer calls in, it is what it's advertised, right? It's a 30-year fixed. It's a ridiculously low interest rate, much lower than where market rates are on average, about 2% lower. Rates have gone up very sharply in the last week. I think today we have probably hit almost 1-year highs. May not be like a 4.99 anymore, but maybe you'll get in the low fives versus the low sevens where rates are today. The end effect, as you can imagine, on cash flow is the difference between a 5.25% rate and a 7.25% rate typically will about double the cash flow on the property. As you can imagine, for investors, it's huge because any of the potential reasons why people may be on the fence now are out the window, right? You want a rate in the fives? Guess what? You can get a rate in the fives. You want 30-year fixed? It's there. The cash flow is there. Typically, this program, it does require builders to, as you mentioned, sign up for it. Basically, the builders incentivize a chunk of money for their buyers. And they do that by paying a lot of money. The builders are paying 6 figures out of pocket to incentivize these interest rates. That way, us as investors can come in and get these low rates and get these increased cash flow. Now, typically when builders do sign up for this program, it is replacing other incentives they have, right? And that's a way they can help justify some of the cost. Although cumulatively, even if the builder gets rid of their 2% seller credit and they get rid of their free management and instead deploy into this program, they're still putting out a lot more money than they were before to take advantage of this. It's a huge opportunity for us as investors. As the end investor coming in, they're coming into a conventional Fannie Mae 30-year fixed, right? at just a ridiculously low rate. There's at the moment a relatively limited amount of builders signed up for this, but that number is increasing by the day. And as you can imagine, if I'm a builder in, Wisconsin and telling to investors and I sign up with this program, right? And I'm able to incentivize and offer rates 2% less than my competitors and obviously dramatically increase cash flow. Well, guess what? My competitors are going to have to sign up for this program too, right? Otherwise they're not going to sell any homes. So I think towards the end of the year, and I'm having conversations with builders every day, guys. So I'm doing my best to get this out to as many builders as we can. That way it's really applicable across a broad level of inventory. But I don't think while this program's around, I think it'll be around for a while. But if you find a builder through Seewing or me that is offering this forward commitment program where the builder can incentivize the rate, jump on it. And the thing that you need to realize is every builder that does it, they're blowing out their inventory. The program's still unknown. Once this program becomes more known, we're going to get back to where we were a year ago, time flies. Years ago, pre-pandemic, you couldn't even buy a home that was going to be built in the same calendar year, right? We were all signing contracts into 2 years, 3 years out from current date. And everyone forgets that, right? You're in a position right now where you can actually buy inventory that's on the ground. And it is getting more competitive again, inventory wise, because a lot of people have gotten off the fence. But as you can imagine with this program, as this program spreads more toward the end of the year, you're really not going to be able to buy a house anymore, right? Because they're going to fly off the shelves. And you look at what's happening to the broader economy and the stock market and the mortgage industry, rates keep going up. Not good for obviously our business, but what has been resilient and continues to be resilient through all of this, right? Real estate. And the only apprehension anyone has right now is cash flow, and which, look, just based on inflation, even if you're break even, you're making money, right? Because you're getting into that 30-year fix. Now you pair it with this program, there's no reason to be on the fence. Take advantage of it. You lock in some low rates, the lowest rates that people project, just the talk here in the industry is, when rates get back to the fives. And when they say that, they mean prime rate homes. So let's break that down. If prime rate home goes down to 5, investor rates will be about 5.5. Seewing and I are telling you, you can get rates lower for a rental home than what the projected new lows are going to be maybe in 6 months to a year and a half to 2 years to 3 years that everyone's waiting for. Guess what? There's a way to do it now, right? So we're just trying to set more builders, and that way you see when you have more inventory, obviously, to offer to all of our mutual clients.
Yeah. Very exciting. Of course, it's going to keep us posted in real time moving forward. So my understanding currently, before we go into other topics, we have several topics to discuss. Well, very exciting podcast. To my knowledge, Southern Impression Homes in Florida, their new products, 1 to 4 units, this loan is currently available. Am I correct?
Yes, correct. On select, not across all their inventory. It's on select inventory.
You have any specific as to which select inventory?
I don't know which neighborhoods off the top of my head.
Okay. Can you post it on that so I could specifically notify my.
Well, I think Jim will probably be the best one and let you know on that, because I don't know what they're obviously inventory wise, what's selling and not.
Sounds good. Investors, my database, and anyone else, get off the fence and take advantage of this great opportunity. And with that in mind, thank you. I'm very excited. This is a game changer. Okay, let's go on. I know you're busy, so we have 3 more slides to go. Here's slide. Just go ahead. What I've seen, especially in the past 1 year, a lot of real estate investors, newbies out there, and even the so-called experienced investors who have purchased 1 or 2 rentals in the past deals, lot of them are still staying on the sidelines for these reasons. Oh, I'm waiting for the mortgage rate to come down to 3%. I'm waiting for the real estate crash to occur 50 to 60%. I'm waiting for the foreclosure rate to come into the market so I can pay pennies on a dollar. I'm going to wait until the recession is over. I'm going to wait until the inflation goes back down to 2%. I'm waiting for all the negative headline news to totally disappear before I get off the sidelines. So
that's great. What's going to totally disappear with that? All the money you have sitting in your bank account being scared. Scared money doesn't make money. This is true. It's because, look, I mean, man, it's crazy. I've been going grocery shopping with my wife now since we have a newborn, and typically I haven't done that in years. And now I'm becoming more aware of what it costs it is almost cheaper these days to eat out than almost even cook at home. You go and buy groceries for two people in a day for a week, and you're spending $300, $400, $500. It makes it hard to sustain yourself. But that points even more at the negative power of inflation, right? Cost double to buy bread, triple to buy everything these days. Guess what? That means your dollar, that $1 is probably 50% less effective than it was 3 years ago, 4 years ago, right? Whatever. If they're saying it's 12% a year, okay, that's 3 years of it. That's 50%. We all know how high it really is, right? So imagine that. Look at the price of cars, right? A Jeep Wranglers go for 60 grand, 70 grand now. Those were $30,000 cars 8 years ago. Once again, the power of that dollar is half as effective. So if you're sitting on the sidelines for all those reasons, and we'll run through them, but you're fooling yourself. And also, more importantly, talk about Warren Buffett, talk about Ray Dalio, right? You don't sit on the sidelines and wait because you miss out on all the market action. How many people in 2013, 14 are like, oh, 7-year cycle, real estate cycles, I'm not going to buy. Values have gone up 100% since then. And look, at the end of the day, I always say this, real estate, right now, the real estate surge and where we are is based on supply and demand. And the supply and demand is not fixed. Feds can increase rates, all this other stuff can happen. But at the end of the day, if there's more buyers for product, then there's product available that is going to drive prices. And guess what? That problem's not being fixed for at least the next decade, even if they started building up new homes today, which they're not. Yeah. Rates aren't going to go back to where they were. The 2.5% 30-year fixed, or the 3%, or probably even the 4% are far into the future, right? If we ever see it, which I don't think we will. The general consensus is the new normal after rates come down sharply are going to be in the 5s. Right now we're in the 7s. The 3s and 4s are not even out of question. It's unfortunately, let's chalk that up to be an anomaly, right? And it was amazing for all of us that do have interest rates that low. That's not coming. And the 50, 60% crash, everyone thought that was what COVID was going to do to real estate, right? Everyone who knew I owned a bunch of real estate, friends were like, oh yeah, how is it going? Are you worried? What's happening? And nothing happened except rents doubled and property values went up 35% in a year and a half. Get away from the fear mongering. If you're new to real estate or if you're seasoned, right? It's just like any investment, dollar cost average. If you're worried about the market, doesn't mean don't buy anything. If you have the funds to buy 6 rental homes, okay. Look, I agree. Things are volatile. Don't go buy 6 tomorrow. Buy 1 tomorrow. Buy 1 4 months later. Buy another 4 months after that, or 2, whatever the number is. And you dollar cost average, right? You buy it at different cycles, different waves in that cycle. And look, maybe worst case scenario, right? Maybe you buy a property tomorrow, 3 months from now, property values do go down. Something dramatic happens, right? Guess what? Buy another one then. That's great. Even better deal than the first deal. And you bought that first one because the numbers did make sense, right? Regardless of all the external noise. You buy another one, and then maybe 3 months after that, values go up again, right? So at that point, you're like, damn, they went up, right? Your whole mindset changes. You want them to go down so you can buy more and get even in better deals, right? But if you're looking at real estate, long term, which you should be looking at it long term because that's where you build wealth. If you're looking at 10 years, who cares if value drops in a year or 2 years? Because they're going to come back up, right? We know that. And if you're not looking to sell, it doesn't matter what some guy says your house is worth on a piece of paper, right? It doesn't matter what's happening in the economy. None of that matters. If you're getting rented, covering the mortgage, so many people sold their homes and short sale and foreclosed in 2007, 2008. And 3 years later, values were right back up there. Except now they were carrying a big L because they had a big foreclosure on their credit and missed out on all the opportunities that arose. Definitely don't believe the headlines. If you're waiting for any of the good reasons, Seewing mentioned, as you always say, buy real estate and wait. Don't wait to buy real estate, and do it intelligently, do it calculated. But at the end of the day, you don't want to have money in the bank, right? The stock market's nuts. Okay. Maybe you guys, I have money in stocks too. Maybe you guys are more comfortable with it, but I can't look tangible real estate, right? That it brings in an income too. A lot of people invest speculatively on stocks to buy and sell versus dividends themselves. But I don't understand how you could invest anything more better than real estate. It's tangible. It's real, right? It's not an E-Trade account. It's not all these other, investments that are going haywire right now, right? Now, yeah, in real estate, rates have gone haywire and that does affect our bottom line. But if you look at the overall trajectory of real estate in the last 12 to 15 years, it's only been going one place and it's only continuing to go one place. Are we going to see 25% appreciation or 15% appreciation or even 10% appreciation in the next couple of years? Probably not. We'll see probably half of that. Things will start to maybe level out a little bit, but they are going to keep going up. It's once again, supply and demand. If you have 60 grand to your name total, you have no other money. Do I say go dump all 60 grand in real estate? No. Dumping half of that, at least in that example, you're losing money not doing anything. It's so unprecedented where we are right now. When you're like, oh, I need to protect this 60 grand. And inherently we're like, let's keep it in the bank. That's the worst thing you can do because you're not protecting it. You're literally just throwing it out the window. Protecting it is putting it in some inflation hedging investments. Real estate, 30-year fix, nothing better to hedge against inflation. You want to go buy some gold bars and stuff, do that. But I think having a comfortable reserve is very important. Don't get me wrong, but excess cash waiting for the right time to invest is wasted money.
Absolutely, Richard. Let me ask something. Now, investors are waiting on the sidelines. They're foregoing the multi-dimensional assets of a real estate asset class, 1 to 4 units. Into property, give you cash flow, great tax benefits, appreciation potential long-term, and the power of the 30-year mortgage. So if you wait on the sideline, you're not going to be rewarded on these multi aspects of holding a property. So people need to think about that. So what's your thought on that? Is that missing out on the totality of multiple ways to make money on a real estate asset class, single family home to 4 units by waiting the sideline, and then you're also going this opportunity loss and opportunity cost. So what are your quick thoughts on that?
Yeah, just that, right? There's so many facets to real estate wealth, and most of it's not what people think, right? Everyone's just after the front end, their cash flow, their ROI. And those of us that are seasoned and owned real estate for a while know that's not what's making us wealthy, right? Even if you can get your 7% cash on cash, whatever, what is that? It's a couple $100 a month, best case. Is that going to make you rich? Okay, get 5 of those. It's $1,000 a month, right? Is that going to change your life overnight? No, it's not. Power of real estate is compounded the longer you own it, right? And what I mean by that is not only do you have the cash flow, which is as you move through longer real estate, that becomes more significant, but initially that's the least significant part, right? So you have cash flow, you have your inflation hedge, you have your return on amortization that you're paying down the loan. You have depreciation, right? So you're able to write off that actual 8%, 7% cash on cash return you're making. Now you're able to write all that off, right? So you save some tax benefits, which really pushes that return up from that 7-8%. But then in addition to that, the real wealth building comes from inflation and the inflation hedge. Properties I bought 10 years ago at new construction that were making $200 a month at the time, $200 a month based on that property rent was about a 7% cash on cash, right? So what is $200 a month doing for me? Nothing, right? But those same properties today, under 10 years later, I think it's 7, 8 years on a bunch of them, the rent's gone from $13.95 to $17.95, right? So what happened to my cash flow? I don't need rents to double for my cash flow to double, right? Cash flow rents went up $400, but all that $400 increase went to my bottom line. So that means my cash flow at 7% ROI went from $200 a month to $600 a month, right? My cash flow tripled. Now the property's making me 20%. Now, 8 years later, I'm like, okay, this is actually real money, right? That's $600 a month times 10 properties, $6,000 a month times 20 properties. That's $12,000 a month. Okay, this is turning into real money. And I'm only 7 to 8 years in, right? Once you're 15, 20 years in, that cash flow dollar number increases, right? With inflation once again. Maybe I'll be making $1,200 a month cash flow per property. Yeah, there's so many different compounding effects of it. And then you throw the cherry on top is 20 years in, you're making all this cash flow. Well, 10 years later, your loans are paid off, right? Then you're ready to retire. Now, 10 doors, 20 doors times 18, $2,000 a month, right? You're bringing in 30, 40 grand a month cash flow. And you don't need to do anything crazy to accomplish what I'm saying, right? Look, and most people listening to this, you make a decent amount of money, right? You probably potentially work for a tech company. You may have RSUs. If you dump 60 to 150 grand a year, buy 1 to 2 properties a year for the next 10 years, you're set on that path, right? You can get aggressive as you want, depending on your exact situation. But I always say, people ask me what my biggest regret was and is with real estate, investing in real estate over the last 15 years. And honestly, it's not buying more and not eating cup of noodles if I have to every day and sleeping on the floor to buy more real estate, right? And I'm sure everyone shares that sentiment. But the house you bought 12 years ago, you're like, man, I should have bought 2 of them or 3 of them. I should have figured out, no matter what, how to buy more. Could you imagine the wealth that would have created, right? Think of your primary homes, most of you out there. Imagine it. And a lot of us may have had that ability somehow to pull money together and buy another house in the neighborhood. That would create lots of wealth. And I actually did that. I have 3 homes in my neighborhood. 2 of them I Airbnb, 1 of them I live in. But it was under that same kind of logic and rationale is I need to pull means together from wherever I can to get as much as I can, because I realize that this rate environment and the price environment and being on the ground level, seeing the supply and demand issue. And that's not an issue that can be solved overnight. So getting away from the noise and the articles and the news and the rates and this and the that, and Fed, and looking straight at supply and demand, right? There's 20 people that want to buy lollipops. I only got 5 to sell. Guess what? I'm going to sell lollipops at $2 a piece. But if I have 5 people wanting to buy my 20 lollipops, I'm going to sell them probably a little cheaper because I need to get rid of these lollipops. Guess what, guys? There's millions of us trying to buy homes and this many available. When that, once again, is not going to, the lollipop factory's broken for the next 10 years. And there's always going to be more buyers for my lollipops than lollipops I have. What's going to happen? Price of lollipops are going to stay pretty high, right? Yeah, there's so many factors, but it's funny because most people just get stuck on that first factor, right? What is my cash flow up front? How much am I making? And I ask you, to those people, what is your cash flow with your money in your bank account? How much are you making? 0. Easy to beat that.
Yep. Sam, great recap. So the remaining few minutes we have, so I'm going to give you a scenario. Okay. 3 scenarios. Currently, we are at 7% mortgage rate. Even with this, because of historic low supplier inventory and still pent up demand, typically we're seeing around 3 to 5 offers, oftentimes more in a lot of different markets. And Not only that, we're seeing like 5 to 10% offer above list price, 8 at 7%. Now, we don't have a crystal ball, but let's play the game anyway, you and I. At, I believe, at 6% mortgage rate, which could happen sooner or later, who knows? At 6% mortgage rate, I predict that we will see 5 to 10 offers per house and 5 to 10 uh, offering price higher than the list price. And if we go to 5% mortgage rate, which some predict in the next few years, who knows? But if that would happen, it's not a healthy market. It is unsustainable. What I mean by that is at 5% mortgage rate, we are going to see 10 to 15 to 20 offers per house. And the final listing price above asking could be 10 to 15% more than asking price. That would create a market friendly multiple bid war, not anything like back in 2021. 2021 is an anomaly. So for investors who does not buy right now, when the competition is very low, when in future, when the mortgage rate come down, you are just like the blind leading the blind, just like the herd mentality. The way my definition of herd mentality is the blind leading the blind. You see the animal shows that I watch over the years, and you have a whole bunch of herds, cows or bison, whatever, thousands of them running one direction. Eventually, they don't even see the cliff. You're going to fall. The first cow could fall off the cliff 1,000 feet into the ground. They die. And the other 1,000 person follow blindly the blind. Those cows fall off the cliff. They all die. The herd mentality, you need to become a contrarian investor. You need to go opposite direction. When herd mentality goes one way, a smart, knowledgeable and investor, you go the other way. It's contrarian. When there's a crisis, there's an opportunity. So for those of you who are sitting on the sidelines, waiting for the perfect time to buy, you're going to run into higher competition, higher multiple offers, and the price will be much higher than it is today. Now, today, you can get ahead of the crowd, get ahead of the curve, buy now, lock in your great rate, lock in your cash flow, and just sit tight and let everybody just follow herd mentality. And they are, so that's my thought. So 7% rate, 6% rate, 5% rate. What are your thoughts in terms of what I just said?
The first thing that comes to mind is that program that we shared on one of your other webinars, right? Where investors with the specific builders have opportunities to get those 5% rates today on rental properties, right? Don't wait. The second thing is, as we had a webinar on this in the past too, was you're married to the property, you're dating the rate. So why wait till competition's nuts again when rates drop? Buy now at current rates and then refinance when rates do drop, right? But at that point, you're not following the herd, you're not battling the herd, you have already bought your property. Now you're just refinancing to increase the cash flow based on your prudent decision to buy it when things weren't crazy. It's funny because if you look back years and years, we've been having these webinars, and so far, everything that we've talked about has come to fruition, right? And it's not because we're geniuses, it's just we're on the bottom line and we can see through the headlines because we see what's actually happening, right? And years ago, when there was doom and gloom, not a year, up until 3 months ago, right? Everything was doom and gloom. Now everything's like real estate on the rise, rents rise, and everything's positive, right? Once that change happened. But for a while, it was all doom and gloom. It was all BS. It was all nonsense. It was all the opposite of what we're experiencing on the ground lines. And now you see a year later, 8 months later, the media is all like, oh yeah, everything's real estate strong. And are we going to talk about it last year? You've been wrong until yesterday that you woke up and decided that real estate is actually a good investment and is robust. And nationally, home prices are up year over year from last year. And the national average for a primary home is almost low 400,000 right now. That's the average price across the U.S., right? And people used to think, oh, you go out of state and buy a home for 200,000, 300,000. Those days are gone. that 400,000 taking into account a lot of podunk places, right? Where property, you can still buy homes for 80 grand, 100 grand, 150 grand in decent areas. But if the average is 400,000, that's almost scary that the national average is 400,000. But I think it was only like 4 years ago, the national average is 200,000, right? You know what that I think of right away is not like, oh, price is going up. How much wealth has been created between those two national average statistics, right? The average home price doubled in the US in the last 3 to 5 years. Man, a lot of investors made a lot of money. If you think about it.
Yeah. Richard, you and I have purchased 2 rental properties in the past 12 months. You have purchased a lot more, not only the past 12 months, you have purchased consistently for the past decade and more. And so you and I and a handful of our investors are buying, even as we speak right now. They have bought last year, they have bought 9 months ago, they have bought 3 years ago. Our handful of investors that you and I guide and consult along the way, you as an investment loan agent, me as a real estate wealth advisor, well, people that bought have no regrets. They are laughing their way to the bank. So, yeah, I know.
Yep.
Newbies out there, whoever they are, it's just it's so sad. Investors are sitting on the sideline. Turnkey, mom and pop investors sitting on the sideline. It's absolutely sad that they are just paralyzed by this fear, these negative headlines and all that. Take the plunge, take the first step, or whatever it takes. Never a wrong time to buy investment real estate, especially right now. So as I leave you, I know you're extremely busy. You have a lot of loans to do, rate lock and all that stuff. You're helping a lot of investors to finance their purchases in all 50 states. One quick final, I know you have great thoughts and great inspirational thoughts and share with us. Thank you so much. So one quick final recap before we exit this podcast.
As we always end with, buy real estate and way, be conservative with your investment. Important to obviously add some reserves, but if you have money that you're waiting to deploy on investments, you're losing money. You're losing a lot of money versus putting it in an inflation hedging investment like real estate. And if you would have listened to us years and years ago, you would have made a lot of money by now. And be conservative. But yes, I think I know I can confidently say real estate always goes up. And history proves that. Are there going to be cycles in between? Yes. That's why it's important to make smart decisions and smart investments and make sure you have good financial health when you're making these investments. But look, if you're buying it long-term and you're buying it 10 or 15 years, it doesn't matter what happens in 5 years. It doesn't matter what happens in 6 years. So the only thing that matters is 15 years from now, when you do plan on exiting the investment, where are things then, right? And things inevitably will be higher with real estate always, as time goes on, just based on inflation. So happy investing all.
Thank you so much, Richard Advani from Guarantee Rate Mortgage. Thank you so much. And everyone for watching. This is Seewing Yee. Have a nice day and we will see you on the other side. Goodbye.